You remember we spent 3 lectures on explaining the economic factors. So it is little technical, but and I think comparatively the lengthiest chapter in the entire course. So be vigilant. Some calculations are also involved in it. Okay, and we are going to take some more questions as compared to other chapters as well. So equilibrium is the selling price above which the number of the units demanded by the market starts to decline. So it's simple. Equilibrium is when things are equal, so it cannot be above or below. It's a tick, right? Equilibrium means equal. I have explained when we were discussing this chapter. So equilibrium, by the word equilibrium we can get something that is equal. So when something is above or below, so automatically it cannot be equilibrium. So you can easily assess this statement, it's wrong, right? Okay, so first is gone, so this is automatically gone. As the selling price of the product increases, the number of the units supplied by the market will also tend to rise. So yes, it is correct. We said that when the price goes up, supply also goes up. So this is the right answer. Okay, so you just need to remember these kind of tricks, right? Okay, product A and B are substitute. Important word is substitute. Remember substitute, those goods which can be replaced for one another, or those which satisfy the same needs, right? Like Pepsi and Coke are the substitute goods. Okay, now this is first point. A 5% change in the price of A, for example Pepsi, has resulted 4% change in the demand of B, for example Coke. What is the cross price elasticity between A and B? Now this is very interesting, right? 5%. So here you need a little calculation for it. So we have said percentage change in demand divided by percentage change in the price. So we can have percentage change in demand is 4, percentage change in price is 5, multiplied by 100, you will get the answer, right? So here comes what? If you do not multiply it by 100, you will get if you multiply it by 100, you will get the answer in percentage. If you do not, so here the answers are not given in percentages, so it's simple 0.8, right? Now the question is, these two options are gone. Now the question is, it is point plus 8 or minus. Now how? You see, when the price of, let's suppose Pepsi increases, so the demand for Coke, demand for Coke, when the price of Pepsi increases, demand for Coke will increase or decrease? It will increase, right? Because some people will leave Pepsi and will come to the Coke, right? So what happens? So demand for Coke is increase. So you see, two variables are moving in the same direction, so there is a positive relationship. So this is the right answer. So this is, you have to do it, right? It's a little technical. We practice on in this chapter. There are a lot of numericals even given in your study text. You can have some more from the internet as well, and if still there is some confusion, you can discuss, share, I'll solve it for you as well. So these type of questions usually come in your exam, so you must be very good at the calculations and you know the formula, so that you can solve all these questions very well, right? So this is how this is going to be done. The next is G company increases the selling price of its product, and GF, let's suppose 1000 by the 5%. This causes a reduction in the number of unit by sales by 8%. So you see, the selling price is increased, the price is increased, and demand, because the sales decreased. Okay, the price is increased by 5% and the sales decreased by, so price is increased by 5%, sales decreased by 8%. So you remember we have studied when the changes are equal, it is equal to 1. So since the changes are not equal, so this option is gone. Okay, is this price elasticity demand will likely be negative? So all the demands are likely to be negative. So there's nothing. This option is automatically you can say excluded. Now is it greater than 1 or less than 1? Now you see the change in the price is 5 and the change in demand is 8%. So means a small change in the price bring about a bigger change in the demand, percentage change in the demand. So we'll say it is a relatively elastic product. So whenever there is a relatively elastic product, its answer is always 1. Even you can solve it by this. So 8 divided by 5, you will get 1 point something, right, or 1.25 or something like that. So greater than 1 is the right option. So I'll in fact advise you to have little practice on this elasticity, solve some numerical question in your notebooks, and then you will have a grip on it. Like the point, there's always a positive the elasticity between substitute good is always positive. The elasticity between the complementary good is always negative. So just by remembering these two statements, you can easily we can figure out the right options. If the question is like this, there's product A is this and B is this, and their substitute and their there is a positive, the price elasticity is positive. Is it false or true, right? So you can easily figure it out. Okay, which one of the following is not the characteristic of what? Perfect market. So if you remember, there are 4 or 5 characteristics we discussed in detail that are for perfect market. So large number of sellers and buyers, customer, supplier, yes, it is the characteristics. There is a perfect information of the customer, yes, it is the characteristic. There are no entry and exit barrier, yes, it is. All the supplier provide the wide range of product and services, no, it is not the characteristic, though they do provide, but it is not the characteristic. So option B is the right option. Which of the following is a feature of monopolistic competition? Few competitors. Which of the following is a feature of monopolistic? There are not few competitors, there are a lot of competitors. Undifferentiated product? No, they are differentiated products. In perfect competition, there are undifferentiated products, right? No major barriers to entry and exit? Yes, it is not the feature, right? Because there are some barriers. Sorry. Which of the following is a feature of monopolistic? No major barriers. Yes, there are no major barriers. So it is the feature of the monopolistic. No advertisement cost. There is a high advertisement expenditure. So 1 means A, B and D are not the feature of monopolistic competition, while C is the feature of monopolistic competition. Which the following is name given to unemployment, which is the result of aggregate demand in the economy being too small. Agree, no, this is macroeconomic portion. Demand is too small to create an employment opportunities for all the people, right? So structural, no, there is nothing mentioned in the structural. Cyclical, yes. Friction, it's not frictional. And real wage employment, nothing given about the real wage. So the cyclical employment means when there is a cycle, now the economies might be in recession, so they are not able to create the jobs as many as it is being demanded, right? Okay, which of the following are typical macroeconomic policy objectives? Economic growth, yes, this is the policy. Money supply management is not the macroeconomic policy objective. Management of inflation, yes, they are managing. Creation of trade surplus, no, they are not the typical, though we want all these 4. You see, and apparently you can see we want all these things, but they are not the typical macroeconomic policy objectives. So option B is the right option, 1 and 3. So you have to understand that. See why we want what? Economic growth, inflation, employment, and sustainable balance of payment. These are the 4 major policy objectives, and through these objectives we may use money management to achieve that objective, and we may have trade surplus. The balance of payment surplus will result in what? Lower economic growth? No, it will increase the economic growth. Unemployment? Not unemployment exactly, in fact inflation. What is surplus? When our receipts are greater than the payments. sorry. So when the receipts are greater than the payments, that is called the balance of payment in surplus. And when receipts are more, so it increases the money supply. So in that case, it may